Hello and welcome to our channel. Today we will be learning about the forces that move the Forex market as well as stock markets and other related markets. Why are there not many people talking about the forces that move the Forex market? Imagine a bustling marketplace, open 24/7, where currencies are the goods being traded. This is the Forex market, the largest and most liquid financial market in the world. Trillions of dollars change hands daily. Whether you're a seasoned trader or a curious beginner, grasping the factors that move the Forex market is key. The Forex market operates on a simple premise, which is the buying and selling of currencies. When you exchange one currency for another, you participate in this global dance. Today, we'll explore what moves the Forex market and how you can stay ahead of the game. Before we explore the factors that make currencies dance, it's essential to understand the stage on which they perform. The Forex market is decentralized, meaning it isn't confined to a physical exchange like the New York Stock Exchange. Instead, it exists electronically, with transactions occurring directly between parties, facilitated by brokers and electronic trading platforms. This decentralized structure allows for round-the-clock trading, as different financial hubs across the globe pass the baton of market activity. Major financial centers like London, New York, Tokyo, and Sydney play significant roles in driving Forex trading volumes. Each center has peak trading hours that coincide with its business day, contributing to the market's continuous flow. This interconnected web of traders, from large financial institutions to individual investors, creates a dynamic environment where currency values are constantly in flux. One of the primary drivers of currency values is economic performance. When a country's economy thrives, its currency tends to strengthen. Conversely, economic weakness often leads to currency depreciation. Several key economic indicators provide insights into a country's economic health, and consequently its currency's strength. Interest rates set by central banks are crucial in influencing currency valuations. Higher interest rates attract foreign investment, as investors seek higher returns on their capital. This increased demand for the currency strengthens its value. Conversely, lower interest rates can lead to capital flight, weakening the currency. Other economic indicators, such as gross domestic product growth, inflation, and unemployment rates, also play significant roles in shaping currency valuations. Strong economic data generally boosts a currency's value, while weak data can have the opposite effect. Section 4: Political Tremors shifting the landscape. Beyond economics, the political landscape can significantly impact currency values. Political stability and sound governance are attractive to foreign investors, instilling confidence in a country's economy, and by extension, its currency. Conversely, political instability, policy uncertainty, or geopolitical tensions can trigger currency volatility and weaken its value. For instance, elections, government changes, or major policy announcements can introduce uncertainty into the market, leading to currency fluctuations. Similarly, geopolitical events such as trade wars, conflicts, or diplomatic tensions can significantly impact currency values. These events often lead to risk aversion among investors, causing them to seek safe haven currencies like the US dollar or the Japanese yen, driving up their value. Understanding the political landscape and its potential implications is therefore crucial for navigating the Forex market effectively. Market sentiment: the crowd's sway. Economic and political factors provide a basis for currency valuations, but market sentiment, the psychological attitude of traders, plays a crucial role. Driven by news, rumors, and emotions, sentiment can amplify or contradict fundamental factors. Positive sentiment leads to buying pressure, driving up value. Negative sentiment causes selling pressure, weakening the currency. Understanding sentiment's impact is essential for traders. We also have technical insights. While fundamental analysis focuses on economic and political factors, technical analysis examines historical price charts and trading volumes to identify patterns and trends that can indicate future price movements. Technical analysts utilize various tools and indicators, including moving averages, support and resistance levels, and chart patterns, to gain insights into market sentiment and potential price direction. Technical analysis operates on the premise that price movements are not entirely random and that historical patterns can repeat themselves. By identifying these patterns and understanding their potential implications, traders can make more informed trading decisions. While technical analysis can be a valuable tool, it's essential to note that it's not foolproof and should be used in conjunction with fundamental analysis and risk management strategies. Thank you for watching till the end. If you enjoyed this video, please give it a like and subscribe to our channel for more content.